Welcome to the Deep Dive, where we try to take the market's biggest stories and really just boil them down to the facts you need to know.
And today, we have a huge one.
A really huge one. We are wrestling with the 7 companies that have pretty much run the entire stock market conversation for the past few years.
Oh, yeah.
We're talking about the mighty, magnificent 7.
That's Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla.
The concentration of returns in just those few names is just an extraordinary thing to watch.
It really is. You can't really be well informed right now without understanding what's driving each of them individually.
Before we jump into those massive market caps, welcome to everything you need to know about finance.
Our goal today is pretty simple, really. We're just going to try and cut through all the noise, all the headlines, and pull out the most current relevant data. We're
Yeah.
talking Q3 2025 financials, recent news,
Right.
and just identify the key forces. Is it AI? Is it the cloud? Or is it these massive user ecosystems that are defining these titans right now?
And as always, remember, this is purely a deep dive into the analysis and the data. It's not in any way financial advice.
And if you find this kind of thing interesting, please do like and subscribe. It really helps us keep these deep dives coming.
Okay, let's unpack this. I think we should start at the foundational layer. The 2 companies laying the core scaffolding for this whole tech boom.
The AI infrastructure frontrunners. Absolutely. The whole conversation right now about scale and speed and growth, it all starts and ends in the data center.
Which puts Nvidia and Microsoft in a uniquely powerful position.
It really does.
So let's start with NVDA. I mean, to say they've transitioned from a gaming company to a data center dominator is almost an understatement.
It is. And their software ecosystem, CUDA, that's the key. It basically acts as this deep competitive moat.
Yeah.
It just locks users into their hardware.
And the numbers, they absolutely reflect that moat. You look at their market cap, it's sitting around, what, $4.59 trillion?
Yeah, just pause and think about that number. It's a valuation larger than the GDP of entire major countries. And their latest report, Q2 2026, showed revenue growth up 55.60% year over year.
Wow.
The demand for their GPUs is it's insatiable.
But is that valuation really justifiable? I mean, just on data center demand alone, the risks feel huge. Their PE ratio is sitting at 53.27.
And that PE over 50 is so critical for you to understand. It means investors aren't just expecting massive growth. They're expecting phenomenal growth, and for it to be sustained for years.
So there's basically zero margin for error.
Exactly. No room for operational mistakes, no room for a serious competitor to emerge.
And that takes us straight to the news. We just saw SoftBank sell its entire $5.8 billion stake. A
Yeah.
sale that big?
Yeah.
That's not just routine profit-taking, is it?
I don't think so. It could be, sure, but it also signals a worry about the competitive landscape. I mean, every major player, Microsoft included, is developing their own custom AI silicon. And if that competition starts to erode NVIDIA's lead, or if, geopolitical export controls get tighter, that valuation comes under threat immediately.
So if Nvidia is the one selling the picks and shovels for the AI gold rush,
Then Microsoft, MSFT, is the one building the towns and the railroads. They are the software and the cloud platform. They just nailed the pivot from enterprise software to their intelligent cloud, Azure.
it's the ultimate success story in corporate digital transformation.
And their value now is tied directly to Azure and, more importantly, the expected monetization of AI across their whole product stack. That partnership with OpenAI is the catalyst.
And they are backing that bet with serious cash. I saw they're planning a $10 billion investment in a Portuguese AI data hub.
$10 billion. That's the kind of global infrastructure push that keeps you at the top of the cloud wars. And financially, they are executing. Their latest Q1 2026 revenue was up a really strong 18.43% year over year.
So the market cap is now, what, $3.81 trillion?
Yeah.
But I have to ask, how much of that 18% growth is just the high tide lifting all the cloud boats? And how much is actually unique AI-driven value that, say, Google Cloud can't match yet?
That is the right question. Microsoft's valuation isn't just about raw cloud services anymore. It's the belief, the anticipation that they can charge a premium for AI integration like Copilot across Office 365.
So they're turning a Word document into a subscription AI assistant.
Exactly. And that completely changes the economics of the entire enterprise software market.
Okay, so if Nvidia and Microsoft are laying the pipes, who's actually delivering the water and charging the consumer? Let's pivot to the next 3, the ones who own the user interface.
This is where you get into established global power and just massive user retention. And we have to start with Apple, AAPL, still the global consumer electronics giant.
Defined by that sticky triad of the iPhone, services, and wearables. And it's still the largest of the group, market cap around $4.05 trillion.
And while the iPhone is the foundation, you're right, it's the services division, the App Store, iCloud, that provides that explosive high-margin growth.
That's the key tension, isn't it? Their valuation depends on services, which are super high margin, but something like 60% of their revenue is still tied to the lower margin cyclical hardware business.
It is. But that services growth is what drove their Q4 2025 net income to increase by a staggering 86.39% year over year. That's just pure cash flow leverage.
And everyone's watching for their own AI models to drop. How they integrate that into the user experience is going to be a huge catalyst. That and their massive share buybacks.
And we have to mention this one thing. It's not just a funny anecdote. It is a brilliant market signal. They just released the $229.95 iPhone Pocket Sock.
A $230 phone sock.
Exactly. It proves that Apple's brand has become a high-margin service in and of itself. They can command absurd pricing for anything with their logo on it.
Which insulates them from a weak economy better than pretty much any other hardware company.
Absolutely.
Speaking of powerful engines, you can't talk about high-margin services without moving to the most powerful ad engine on the internet, Alphabet, GOGL.
Right. Their core search advertising is still this immensely powerful cash generator. It's what supports that market cap of $3.39 trillion.
And that cash engine is just humming. Q3 2025 financials, a net income of almost $35 billion. That stable profit is what lets them fund all those high-risk, long-term ventures.
Which are their key catalysts? AI baked into search, of course, continued growth in Google Cloud, and then you have their other bets division, like Waymo just launched robotaxi freeway services in San Francisco, LA, and Phoenix.
That's real-world revenue potential, not just some R&D dream.
For sure. But the flip side is risk. Alphabet faces constant regulatory and antitrust scrutiny all over the world. Plus, ad demand is always sensitive to the economy. A slowdown hits them hard.
And finally, in this ecosystem group, we have Meta Platforms, Meta.
Huge social media giant. Still focused on ad monetization with Facebook, Instagram, Threads, while also pouring billions into reality labs? The metaverse.
The recent story is fascinating. It's this contrast between strong revenue growth and just wild profitability swings.
It really is. Q3 2025 revenue grew strongly, up 26.25% year over year. But, and this is the detail that stunned analysts, their net income fell sharply, down 82.73% year over year.
Wait, hold on. An 82% drop in net income? What on earth happened?
It was two main things. First, heavy front-loaded investment in AI. But the big one was an extremely high effective tax rate of 87.49% for that quarter.
87%.
Yeah. It's probably a one-off thing related to international tax adjustments, but it definitely signals potential complexities for investors to watch.
So the big question for them is, can their new focus on cost discipline plus AI-driven ad targeting sustain profit growth with these huge investments? They just announced a plan to invest $1 billion in a data center in Beaver Dam.
That investment says it all. They're sacrificing profit now to build massive AI infrastructure because they believe AI optimization will generate way more efficient ad revenue down the line. It's an aggressive bet.
Okay, let's pivot to our last two. The ones that embody disruption by mixing traditional physical businesses, retail, and auto with these high-growth tech platforms.
Yeah, these are two of the most complex stories in the group. We're talking Amazon, AMZN, and Tesla, TSLA.
Amazon started as the everything store, but it really evolved into a cloud company.
Absolutely. AWS is the critical profit center. It's what drives their entire $2.62 trillion valuation. Without AWS, Amazon is just a gigantic low-margin retailer.
And you see that duality so clearly in the Q3 2025 results. Revenue was a staggering $180 billion. But free cash flow saw a massive 61.3% decline year over year in that same period.
That FCF decline tells you the real story of Amazon right now. They are prioritizing colossal capital spending, building fulfillment centers, automating logistics, expanding cloud infrastructure over immediate shareholder returns.
It's a huge long-term gamble.
A very expensive one. So the key things to watch for them are AWS margin expansion, the growth in their ad revenue stream, and whether they can finally use automation to cut costs on the retail side.
And then there's Tesla, TSLA, an electric vehicle maker whose $1.30 trillion valuation is tied less to car deliveries and more to, Well, hopes and dreams.
Hopes and dreams about energy storage and, crucially, future software revenue from full self-driving, or FSD.
The stock is famously volatile, which isn't surprising with a PE ratio around 273.
That number tells you everything. It's valued as a software and energy company first and a car company a distant second. And the operational reality is tough. Q3 2025 net income fell nearly 37% year over year.
But what's so fascinating is the contrast in the news. You have shareholders approving Elon Musk's staggering, trillion-dollar pay package.
Right, signaling enormous belief in that software upside, completely ignoring the current financials.
But at the same time, news breaks that their China sales fell to a 3-year low.
Exactly. It just underscores the brutal reality.
Hmm.
Faith in future software can only prop up the stock for so long before operational weakness catches up. Volatility is the rule for Tesla.
So if we connect the dots across all 7, the infrastructure players, the ecosystem giants, the disruptors, what does it all mean for you, collectively?
The collective impact is clear. These 7 names have completely dictated the returns of the S&P 500 and the Nasdaq. It's a concentration of the market, unlike anything we've seen in a long, long time.
If these 7 have a bad quarter, the entire index struggles.
Pretty much. And the common threads driving them are all connected. You have AI adoption, you have massive cloud and data center spending, and you have a broad advertising recovery. They're all drinking from the same well.
And because their growth drivers are connected.
So are their risks. All 7 face headwinds from the consumer economy, from high regulatory scrutiny. I mean, they're all big tech. And critically, very high expectations are already priced in. Any small miss could trigger a big correction.
So, to quickly summarize for you, AI infrastructure is the absolute backbone for Nvidia and Microsoft. Established ecosystems and ad revenue are fueling Apple, Alphabet, and Meta. And that blend of disruption and tech is key for Amazon and Tesla.
And here's the provocative thought I'd leave you with. The future profitability of this whole group, especially the hyper-valued names like Tesla and Nvidia, it hinges less on their current performance and more on whether they can actually sustain AI monetization outside of just infrastructure. How does AI truly transform Apple's services? Or Meta and Amazon's ad targeting to a point that justifies these valuations? What if the AI engine stalls or competition rapidly decentralizes compute power and shrinks those fat margins? That's the question you should be mulling over right now.
A very good question indeed. Thank you for diving deep with us. To continue exploring complex topics just like this one, try out our latest episodes wherever you listen.